Hello everyone, welcome to another exciting session of School for Becoming a Smart Investor. In today's video, we'll learn about what is economic cycle or business cycle and what are the different phases of business cycle or economic cycle. Basically, economic cycle is the natural fluctuation of economy between periods of expansion, that is growth of the economy, and contraction, that is the recession happening in the economy. Every country goes through the economic cycle, and the phases of cycle at which the country is in has direct impact both on industry and individual companies operating in them. There are basically four phases of economic cycle. They are the peak phase, recession phase, depression phase, recovery phase, and expansion phase. Let's start from expansion phase. Let us try to understand what is expansion phase. During the phase of expansion, there is an expansion of output, income, employment, product prices, and profits. As the economy expands, the economic activity and investments increase, and interest rates are low. Inflation starts rising, and at one point of time, demand reaches an all time high. During this time, business optimism is at its peak, and sooner or later, economy and stock market reaches its peak and then starts to come down again. Next phase is to discuss is recession phase. During this phase of recession, the economic activities slow down when demand starts falling. The overproduction of the future investment plans are also given up. There is a steady decline in the output, income, employment, prices, and profits. Businessmen who were earlier highly optimistic start losing their confidence and become pessimistic. Economic activity and investments decrease. Interest rates start rising. Inflation remain high and companies start finding it difficult to sell their products and services. Now let us try to understand or discuss about depression phase. During this phase, there is a continuous decrease in output, income, employment, products and prices, and profits. As the economy contracts, economic activity and investment decreases significantly. Interest rates are high, inflation starts reducing, and at one point of the time, demand reaches an all-time low. During this period, companies are crippled by high borrowing and falling sales and are forced to curtail production or stop their production and close down the plants built during the expansion phase. This is the most painful period and stock prices can crash to any levels during this phase. During this time, business pessimism is at its peak and sooner or later economy and stock market reaches its through and then starts to rise again. Now let us try to understand and discuss about recovery phase. During this phase of revival or recovery, there are expansions and rise in economic activities. When demand starts rising, production increases, and this causes an increase in investment. There is a steady rise in output, income, employment, prices, and profits. Businessmen who were earlier highly pessimist starts gaining their confidence back and become optimistic again. Economic activity and investment increases, interest rates starts reducing, inflation remain low, and company starts expanding their business once again. All this results in revival or recovery of the economy, and later on economy starts to expand again and the cycle repeats. Now the time from one economic peak to the next or one recessive through to the next is considered a business cycle. Now, after understanding the business cycle or economic cycle, now let us try to understand when to invest money in this stock market based on our this understanding. The economy and the equity markets exhibit cycles and patterns. The stock market tends to lead the economic cycle, that is, the a bear market will typically start before economy moves into recession, and a bull market will typically lead the economy out of recession. Now you can see from this figure, the red line indicates the market cycle and the blue line indicates the business cycle. Now you can see that this market cycle begins before the business cycle. Okay, and then once the market cycle begins, okay, it reaches to its peak value, and this is happening because of the bull market. That is, the bull starts pulling up up direction. That's why we call it a bull market peaks. Okay, and then once the market slows down or it is falling, and we call it a bear market. Okay, and when this market falls down, okay, and that will, you can see, it further goes down. Okay, and then it goes to the recovery phase, okay, the market, and then again it goes to the bull market. All right, and reaches to its peak, and you can see a considerable lag of the market cycle and the business cycle. So business cycle lags but the market cycle almost like 6 months. So it is advisable to determine the stage of economic cycle, and based on that you can assume or you can understand the market cycle, or you can predict the market cycle based on your economic or business cycle. Ideally, long-term investments should be made near the end of the depression or when the economy begins to recover. Similarly, investors should divest or pull out their investment either before the end of the expansion period or at start of the recession period. The time lag between the market cycle and the economic cycle is around 4 to 6 months as mentioned earlier. But this time duration may from one cycle to another cycle may vary. Okay, the 4 to 6 months can be more little higher or it could be little lesser. So people, thanks for listening. That's all for our today's video. Let's meet in our next class. Please like, share and subscribe.